Hi, everybody, and welcome to today's webinar, Tax Talk 2024. We are recording the webinar today, and by the end of today, that will be in your account. So if you missed something and you want to go back and watch something on your recording, which a lot of I know you do because Chris is going to be giving you so much information, that will be in your account before the end of today. To get to those webinars, this is the very most important thing, is to make sure you're logged in at crrs.com. You need to go there, click on login up at the very top. If it shows you are logged in, but you still don't see your stuff, sometimes what can happen if you've been logged in a long time, it'll automatically log you out. So just go ahead and click on log out and then log right back in. Once you get in there, you're going to see my dashboard. Click on that, then you'll see a lot of things to click on to update your profile and all of that. But just look for the one that says My Education. Now you're going to see all your webinars, any past courses you've taken. If you want celebration, it'll be in there, all of it, all your education. So that's how you get to, if you sign up for this webinar bundle and you haven't been able to make them all, but you want to watch the recordings, that's how you get to those. But that will be in there by the end of today. The slides will be there and all of that. Today's webinar, we have, it's on the website now, we have announced it, but just in case you missed it, it's probably going to go longer than a normal hour. We're looking at probably about 90 minutes, and then with the Q&A, it could even go a little bit over that. But just remember, like I said, we are recording it. So if you have to jump off, remember, you can come back and start that recording where you left off and take it from there. But anyway, before I go on to introduce our speaker, when you do put your questions in the chat box, if you can change that to where it says to, change it to everyone. And then everybody can see where you're from and everyone can see your questions and your comments. So right down there, you only have to do it once, and then everybody will see where you're coming from. And I'm very excited about the webinar today. We have an awesome speaker back with us today. Most of you probably know him, but his name is Chris Bird. He is out of the Champaign, Illinois area, and he's one of our CRS certified instructors. He's taught many of our live courses and done many of our webinars for us. He's actually did our very first webinar when we got into the webinar business, and that was way back when. And, we both probably looked a little more younger back then, but here we are today, and we're back. And Chris, how you doing today?
I'm doing really well, Paul. How you doing? And everyone, Paul and I were the first ones, and I think they got a picture of Paul and I on a wall or something like that from the first webinar. And now Paul was telling me earlier about 1,500 webinars later, if I'm not mistaken, that Paul's been involved with. So yeah, Paul and I go back a long way.
Oh yeah. Well, Chris, I know you have so much to share, so I just need to get out of your way so you can go ahead and get started.
Very good. And Paul, thanks a lot. And welcome, everyone. I think we have about 75. And I'm just seeing the participants come on. And Joanne Fraser, shout out to you and my Kentucky people, Oregon, California. I was just watching where people were signing on from. Welcome, welcome, welcome. And I'm talking to you from Champaign, Urbana, Illinois. And I've literally been all over the country doing these seminars on the topics I'm talking about right now. I was in Anchorage several weeks ago, Seattle, Phoenix, and there's just a lot of interesting things going on right now. And I don't think it's going to stop in Washington. No major tax laws brewing right now, and with tongue-in-cheek comment, how messed up things are in Washington. And then we've got global issues going on. Most of us in my business don't think that we're going to have any major legislation. We sure haven't so far in 2023. And it's getting very close to the end of the year, and we don't think it's going to happen now, but you never know. I mean, they may tie some loose ends up that do need to be tightened up, and I'll kind of give you my input on that as we go through here. But as always, everyone, I've got a certain amount of material to cover. I've got about 53 or 54 slides, all of which you'll get a copy of from Paul. And I want to make sure that if you want to stay on with me after I'm done with my presentation with a question, you're welcome to. I'll stay on for several hours, everybody, just to give you your money's worth and talk to you and things like that. So here we go. All right. So my background, and I have to get control of my PowerPoints. My background, everybody, I've been doing this for a long, long time. Ex-IRS agent, mainly involved with criminal work when I was an IRS agent. I'm enrolled in practice for the IRS. I'm a certified financial planner. I've been a CRS instructor, certified since 2002, and that's where I've met many, many of you on the road speaking, conventions, things like that. I'm a licensed Illinois real estate broker, although I do not have the time to sell real estate. I'm on the road too much, and but I have to have that as part of being a CRS certified instructor. So enough about my background. So let's kind of lay the ground rules. So always, everyone, my job in this business has been to keep you informed. The second bullet on this page about significant issues in taxation. And I've been told many times that, I tell you before your accountant tells you, and that's good because, they usually learn the newest stuff in October, November, December of every year when they go to seminars to get ready for the next tax season. And that's what I'm getting geared up to do right now. I start teaching for Auburn University tomorrow. And then I start making my way through the southeast of the country, doing a lot of work for accountants and attorneys, things like that. So, nothing that I say ever replaces your need for a good, competent tax professional in your life, whether that be everybody, a CPA or enrolled agent, whatever. And I'll just give you a good example of this. And I got a good friend of mine, everybody on this webinar. Her name is Joanne Fraser, and I know her accountant in California, and I'm just going to mention his first name, and you can get a hold of Joanne if you want the rest of it, but his name is Richard, and I help Richard with some tax issues, and he's come to some of my seminars, and he's very, very sharp, and that's what you need, everybody. You need somebody that really understands the business of real estate, and if you own investment real estate, and I'm a big proponent of that, you need an accountant that understands that as well. So I highly recommend you employ the services of a CPA or an enrolled agent, everyone, somebody that really has the credentials to do a good job on your tax representation. And then please feel free to show the PowerPoint to your accountant. I can back up anything I teach you today, and I'll have a three-way with you. I mean, you want to get your accountant and I on a phone call with you over an issue, if you can catch me, and I'm Paul was lamenting that today, that I'm on the road so darn much, everybody. When you are speaking all day, you've got your phone off, and I am hard to catch sometimes during the speaking season. All right, so it also goes without saying in this business, you've got to invest in RPAC, everybody. The Realtors Political Action Committee, just both from the federal level and your state level of this. There have been so many attempts by, in my opinion, an uninformed Congress in Washington that would love to take away the home mortgage interest deduction because of the revenues it would bring in from taking away that deduction. Or the 1031 exchange, everybody. I shudder to think the values of commercial and residential real estate, how they might be affected downward if they did away with the 1031 exchange. So, whatever little you want to invest or become a life member, I don't care, everybody, but find a way to invest in RPAC and keep Congress away from some of these tax issues that really, really impact the benefits of home ownership and investment property. All right, so brand new right out of the chute, everybody, right off the chute. I've got a lot of good news for you today. I mean, a lot of good things, but I got a bad thing to start right off. And it's called the Corporate Transparency Act. And this came about a couple of years ago and has been put off and put off and put off. Well, 2024 is the year it's supposed to take effect. All right, next year, January 1st. And we've all got a report to file with the federal government starting next year. If you are an owner, a 25% owner in or more, 25% or more owner in an LLC, a partnership, an S corporation, or a C corporation. And I'll explain this, everybody, a little bit more in detail. But the issue is that if you had to go to your state of residency, for example, Joanne Fraser in California, to set up an LLC or an S corporation or a regular corporation or partnership, if you had to go to your Secretary of State to set up an organization, then the organization starting next year is required to file a report giving specific information on its BOIs, everybody, its beneficial ownership interest. And that is defined as either anybody that controls one of these entities or has a 25% or more interest in one of these entities. So I'm going to introduce this, and then I'm going to ask you all to call your attorney, everybody, call your accountant, talk to me about the Corporate Transparency Act. A lot of people are really upset about this because they form an entity, everyone, to protect their liability, to maybe protect their name and things like this. And then all of a sudden, the federal government's going to have a list of everybody that owns every one of these organizations. And a lot of us feel that this is government overreach, but it is what it is. Now, if you look at the overhead, you'll notice that this report is not submitted to the IRS, everyone. It's submitted to FinCEN, FINCEN, which stands for Financial Crimes Network of the Federal Government. We do understand that this will be a electronic form only. The form, the last time I checked last week, is not out yet. It's supposed to be out as of January the 1st of next year. And the basic rules are this, everyone. I mean, I've seen the fields that are going to be required to be filled in, and they're rather voluminous. I mean, it's like 5 pages of fields. And I'm sure there will be simple reports and middle simple and then complex reports. But you're going to have to pay somebody to do this unless you do it yourself. And I cannot, don't even ask me what it looks like, because I don't even know what it looks like. But I do know this. Your instructor has 6 of these reports to file. 4 LLCs for rental properties that we own, my S corporation, my wife's C corporation. I got 6 of these reports to file next year, and that doesn't make me real happy. Now, here's the due date of these reports. For all of you that are entities as of 12/31 of 23, one of these 4 types of entities listed here, you have until January 1st of 2025, a full year, to file this report. Well, what I'm understanding is that the FinCEN will accept these reports all through 2024 that are due by January 1st of 2025. And what I'm going to do is I'm going to probably include this in my tax preparation season between January 1st and April 15th. Everybody get that done during that period of time, if they will accept them early. And I'm hearing, it is my understanding, that they will. However, on the other side of it, for any new one of these 4 entities filed after or started after 12/31 of 23, 1/1/24 later, the report must be filed originally within 30 days of the organization being formed, and that's recently been changed to 90 days. So before I go to the next slide on this, let me just tell you this. Here's what they're after, everybody. Apparently, there's a lot of bad persons who have illegal income from either human trafficking, fentanyl, everybody, drugs, whatever the case may be, that when they catch one of these people, all right, then they're going to have a database of the entities that they own, all right, for the 50 states, everybody's Secretary of State's office. And apparently it's going to be a trail to where the money is and things like that, because the theory of this is that a lot of these perps are using domestic entities to basically launder their money through, and that's what they're after. What bothers me, all right, is for the millions of us doing it right. I mean, I clearly have not laundered money ever. I've not done anything illegal, but for the millions of us to do it right, we got to do this report for the very few that are breaking the law, and that bothers me a lot. All right. Now, just to show you how current this is, look at this report, if you would. And this is from Kiplinger Letters. I take the Kiplinger tax letter, and this was as basically less than a week ago. All right, this is a little bit more on this, everyone, if you're interested. So the beneficial ownership reporting regimen, which will certain corporations, LLCs, etc., must report information about themselves and their beneficial owners to the Financial Crimes Enforcement Network of the U.S. government. There are a number of exemptions to report. Who does not have to report, everyone? Well, it's operating companies with at least 20 full-time employees or over $50 million in gross receipts and having a U.S. office. So let me just tell you this. All the big companies of this country do not have to file. Banks and credit unions are exempt from this, all right? They're after us, the little guy that apparently these perps are using to launder their money through when they own these small entities. So the underlying point here is that originally for entities formed after 12/31 of 23, we only had 30 days to file this report, and now apparently they've extended that to 90 because of a lot of complaints about how voluminous this was going to be and all that good stuff, difficult, et cetera, et cetera. So Paul was asking me about what I'm going to be talking about in the February 7th webinar. Everybody, I always do one fall and then one spring during the tax season. May I guarantee you that this will be one of the topics of discussion then. The hope is that the federal government will back off of this for another year, because a lot of you, this is the first time you've heard about it. Boom. All right. So are your accountants hearing about this? And there are going to be a lot of people upset about it. Maybe they'll back it off, maybe they won't, but we've got it on us right now as we speak, unless they do back it off. All right, so now I want to talk about something that I've always kind of moved around and discussed at different seminars, but now I want to talk to you about the concept of push-pull, everybody. I was in Phoenix, Arizona, speaking for a friend of mine several weeks ago, and she said, Chris, tell us about push-pull. So I'd forgotten that I'd really covered it that way, but just to simplify it, everybody, push-pull, all right? Let's talk about this in terms of income and expenses. So now is the time to think about this. October, November, and December every year. So you know what kind of year you've had financially in real estate so far, right? And you should, in the late October now, kind of know what deals are going forward, everybody, and what's looking like it'll close this year, things like that. So you ought to be able to put a handle on your gross commission income so far this year. And then I would hope that you've been keeping up to date with your expenses for the year, so you kind of have a decent idea of what your profit may look like, all right? So now, is it going to be up, everybody, and we'll go one way with this, or will it go down, all right? And then we'll go another way with this. But we're going to talk about pushing income into next year, maybe, or pulling deductions into this year, or the opposite, pulling income into this year, everybody, and pushing off deductions till next year. And it just all depends. There's no one good number, but I want you to think about this. So if you're fortunate enough that your taxable income is really good, all right, your business has been good this year and you're going to have high income, then maybe one of the things you ought to think about in talking with your accountant is, should you maybe defer some year-end closings if possible, into early 2024? And I know the bird in the hands, we're two in the bush and all this good stuff. And maybe a client, everybody doesn't want to defer and all that good stuff. And I understand that, right? And that's why I qualify that first bullet with if possible, something to think about, all right? But then things specifically you can do is pay coaching fees, everyone, for 2024 in December of 2023. And a very easy way to do that is to write a check and mail it to your coach on December 31st. You get the deduction in the year you write the check, not the year the check clears. And then your coach, everyone, will report that in the year they receive it, which would obviously be 2024. And I'm just telling you this works. And that's something I do all the time in my life. All right. Well, the next bullet, purchasing capital items like equipment, computers, staging, furniture, vehicles, etc., that your business needs, but be sure to place them in service, everybody. You can't order that vehicle and have it delivered next year and write it off this year. It's got to be delivered to you this year for you to take the write-off this year. And that doesn't mean you have to pay for it. You got to have a bank loan to pay for it, things like that. And it works, everybody. And the same it goes for your MasterCard or your Visa, and that is that you charge things in 2023 and you don't pay for the credit card charge until 2024, you still get the deduction in the year you made the charge because you're obligated to that expense, right? The same goes for rental property furnishings. I mean, if you're going to put in appliances and you need deductions because you've had a really good year in 2023, then buy those refrigerators, have them placed in service, and those microwaves, everybody, those ovens, and that carpeting, and the drapes, and the ceiling fans, and the granite countertops. If that's what you're going to do and you need write-offs, and you need to do these things anyway, think about accelerating the deductions into a high income year, because don't forget that you want your deductions in your high marginal tax rate years. You don't want your deductions necessarily in your low marginal tax rate years. So, you know, our tax rates go anywhere from 10% up to 37%. So if your taxable income will be high, everybody, I'm assuming you're in the high 20s or the 30s in terms of marginal rates, not the 10 or 15% to take advantage of this. And then, of course, if you have businesses other than real estate business, do not bill clients for services rendered until after the end of the year. And this is what I do every year, class. I don't bill anything I do in October, November, December every year until January of next year. All right. And then I deliberately put off 3 months of income until the following year. And that's totally legitimate. You're allowed to legally manipulate the timing of your income when you're self-employed. The problem as a realtor is you've got a broker, everybody, that wants to pay you after closing because they take a deduction for that. The income comes through, they take a deduction for that. And your broker, I don't believe, is going to want to hold a check for you that they're sitting on December 26th and wait to give that to you until December or January 1st or 2nd. You may ask, but I just don't expect a lot of success with that request. But one more thing, and watch my humor here, right? Look at my face. Once you start this deferral, okay, once you start this push-pull, you need to be real careful to push-pull every single year, everyone, because if I forget, all right, or get sloppy in the following year after I've pushed off 3 months of income, if I don't do it the following year, then I end up doubling my income from those 3 months, everybody, because October, November, December of the previous year will be in January, and so will October, November, December of the current year will be in those months. And you better have a good memory if you're going to exercise these push-pull concepts. Okay, so let's go the other way. Now, what about taxable income could be off in 2023? And, you know, I've got to just reflect what I see with my clients, everyone. I have a number of real estate clients, all in the Champaign-Urbana, Illinois, all Illinois taxpayers. I really don't want to do out-of-state returns. And two of my clients that I've met with in the last week, everyone, one of them will be off 40% of their GCI from 507 in 2022 to a anticipated roughly 310,000 in 2023. And another realtor of mine is going to be off about 20%, everybody lower. And obviously the issues are low inventory, high mortgage rates, class, people not wanting to move up, people not wanting to go from a 3.125 mortgage to a 7.5 to 8%. I mean, you can't blame them for that one bit. But it is reaping some havoc among realtors around the country. I mean, and I've met them both ways, everybody. I've met realtors in my travels that are just, their income's going through the roof. And then I'm meeting people that their income is adjusted downward because of these market conditions. So then what do you consider when your income is down? Well, you might want to push off deductions until next year, because if your income's already down and your marginal rate is down, then more deductions, everybody, will be at lower rates, and maybe that's not what you want to do. Push off paying those until January of next year. All right, so I wouldn't accelerate the coaching payments this time. I'd pay them as they're due every month next year. All right. What you might want to consider, the second bullet from the last, is could you accelerate some closings into 2023 that would ordinarily close in January of 2024, right? Because those closing and that income would be at a lower marginal rate in 2023 than 2024, possibly. And the last thing, and don't ever forget this, and I'm a certified financial planner, this is part of where this comes from, is a lot of you have been told by your financial advisors to either put money into a Roth IRA or convert some of your IRAs into Roth IRAs. And the theory of that, everybody, watch my hands, is tax rates are here now, and after 2025, they're going to go to here, a higher number, all right? So the theory of the Roth IRA is they go in after tax, so you pay your taxes now, or if you convert an IRA to a Roth IRA, you pay taxes on the conversion now at presumably lower rates. And then when the money comes out down the road, out of the Roth, it comes out it comes out tax-free in an environment with higher tax rates, meaning that theoretically the money is worth more because it is tax-free in a higher tax rate environment. That is the clear theory of the Roth IRA and the conversion of IRAs to a Roth IRA. Now, look at this last bullet, all right? The reason I'm bringing this up, everybody, if your income is down in 2023, all right, for whatever reason, then you might want to consider converting some of those IRAs to Roth IRAs. Talk to your accountant about it, all right? Because your taxes are lower in 2023 because your real estate income is down. I mean, you got to take this both ways, everyone. I mean, I've got people that are just knocking the socks off of real estate, and I've got people that are not, right? And they're impacted by the high mortgage rates and the lack of inventory, things like that. So food for thought, there's information for everyone. All right, now let's go long, everybody. Let's go long term. And some of this comes out of the Wall Street Journal, an article I read last week. Now let's push-pull, not from 2022 or 2023 and 2024. Now let's go a little bit longer. Let's push-pull through 25 and 26, all right? And what this is based on is the Trump administration got through the Tax Cut and Jobs Act of 2017, primarily effective for an 8-year period, 2018 through 2025, all right? So, and I am not applauding this. I'm just telling you this is the way it is, all right? And bottom line is there's a number of things that are held down tax-wise for an 8-year period that will not be held down come 1/1/26. And that's a big assumption, everybody, because we don't know what Congress is going to do in 24 or 25 to change anything I'm talking about right now. However, I mean, what I'm talking about right now is clearly correct based on what we know right now today on October 18th of 2023. All right. So look at this slide, if you would. Barring action from Congress, income tax brackets will revert to their higher pre-18 levels, all right, when the tax law expires in 2025. So an 8-year period of time, everybody, everything reverts in 2026 back to 17. This will have an impact on most taxpayers, all right, especially higher income taxpayers. So this particular point is, however, people near retirement who may be at their peak earnings level could see the highest rate, which is now 37, revert to 39.6. And then watch this, people in this position who are planning to convert a portion of the retirement savings to a Roth IRA may want to do it. And this kind of segues back into what I just said. So that's income taxes. Well, watch this. Now, this is a big point, everybody, estate taxes. And clearly, with now 100 people on this webinar, all right, and over 1,000 which will eventually listen to this through the taping process. A number of people listening to this have sizable net worths, everybody, in excess of $12,920,000, which you see on the board in front of you. A married couple, that'd be double that, everybody, 25.84. And clearly, if you yourself are not in that point, there's some of you have relatives, everybody, parents, grandparents, which may be worth a lot of money. And let me just tell you this, just read the articles on this. The largest wealth transfer in the history of this country is about ready to take effect as the baby boomers, my generation, all right, pass on and leave substantial assets to their children and grandchildren. And my wife, Kate, and I, over a cup of coffee this morning, we're discussing exactly this point, everybody. How much we hope to leave to our 4 children and our 10 grandchildren at our passing. All right. I think everybody thinks that way. So here's the deal. Clearly, this does not affect the majority of my listeners to this webinar, but it does impact some of you, I guarantee it. So estate tax, everybody. Now, here's what I've been joking about around the country over the last couple of months. Watch my hand, everybody, and listen to the verbiage. Boom. All right. One more time. Boom. Yeah, I'm a dork. We know that. All right. But I'm a likable dork. So here's the deal. Since the Tax Cut and Jobs Act of 2017, first effective in 18, the federal estate tax exemption has just been going bonkers, everybody. Up. All right. Well, it ends on 12/31 of 25 under the current law. It ends, everybody. The upward trajectory ends on 12/31 of 25 and drops to somewhere in the neighborhood of $6 to $7 million. All right. So look at the slide, if you would, please. The first slide talks about the 12,920 married couple, double that. And then if you're worth over that, everybody, at your death, or you make gifts in excess of that 12,920, there's a federal estate tax waiting to get you, which can go as high as 40%, which can go as high as 40%. All right. So then look at the last bullet here. So the issue now is we've got people that are looking at this and go, boom, boom. All right. What happens in 2026 if they would pass away in 2026 versus 2025 when the 12,920 drops to $6 or $7 million? And everybody, that's what's going to happen under current law if Congress would not extend this. All right. And ain't nobody talking in Washington about this point right now. All right. It's a political bouncing ball. It'll depend on which parties in control of the White House, et cetera, et cetera, et cetera. All right. Now, I'm going to go more into this in just a minute. All right. So going together with this, so I'm going back to screen, estate taxes and gift tax, everybody, are the same thing. There's the 12,920 per person exemption is a federal estate and tax exemption. So what I want to do real quickly, I want to skip past this particular slide and go on to the following slide. Then I'm going to come back to it. So watch this. And I've been teaching this exact slide in all my seminars this whole year, everybody. So look at this, if you would, in the orange box. The current 2023 estate and gift tax exemption is 12,920,000. Estate and gift per person. And the annual gift tax exemption in 2023 is 17,000. All right. And then you see in the mauve or the purple, whatever color you want to call that. All right. The 12,920,000 rises annually in 24 and 25. And then in 2026 drops to 5, 6, or 7 million. We don't know yet what that number is going to be. Now look at the gray box, everybody. This says what I wanted to say. The planning opportunity, if you have high net worth parents or high net worth grandparents, or you are high net worth, well over that 12,920,000, all right? You should be talking to your estate tax attorney. I guarantee these discussions are going on all over this country, all right? To consider making substantial gifts to your heirs in 2023, 2024, and 2025, everybody, to use up that roughly $5 to $7 million between the 12,920,000 and the 5 to 7 million is going to become in 2026, and use that difference up before it drops to the 5 to 7 million in 2026. So I'm just telling you that in rough numbers class, just hear me out if you would. Let's say that you've got a very, very wealthy grandfather worth 13 million bucks, just right over that 12 million. And he's single, right? And he's got one granddaughter, everybody, that one living granddaughter. And I'll lay you money that in the next 2 or 3 years, 23, 24, 25, if they meet with their attorneys, their estate tax attorneys, they would probably have them make gifts to that granddaughter. I'd lay you money of $5 to $6 million of that 13 million, to bring it down to 6 or 7 million by January 1st of 2026, and effectively use up that exclusion. Because once it drops, what it was is gone, everybody, but there's no clawback. There's no clawback by the IRS. The IRS has said they will not go back and claw back what was given when it was that high. Now, one more thing, not in my notes anywhere. Let me tell you this, all right? The point is, gifts are never deductible by the donor, and they're never taxable to the donee. I just want to lay that out, everybody. So nobody's getting a deduction for this. Nobody's paying tax on it. This is all about estate and gift tax planning. Now I'm going to go back to that screen. Another facet of this is making gifts into a 529 plan. And I'm a certified financial planner, and this is big, big information. And clearly, the sick humor here, it's nice to have rich relatives, okay? Because if you have rich relatives, then there's a lot of this going on. But if you have poor relatives, everybody, they got no money to give. So this is not as interesting. I realize that. But here's the deal. When you put money into a 529 plan for the benefit of another, and be kids and grandkids, things like that, all right, it is a gift. You get no deduction for it, but it's not taxable to the recipient either. But what makes 529 plans so cool is when the child uses the money, everybody, to pay for trade school or post-secondary education, et cetera, all right, it comes out of the 529 plan tax-free, and that's cool. Well, the big issue here is that if you really wanted to super fund a 529, you're allowed to give up to 5 times the annual exclusion, and the annual exclusion is 17,000. So 5 times 17 is 85 grand. All right. And a married couple, everybody double that to 170. You can put a lot of money away into a grandchild's 529 plan or a child's 529. You get no deduction for putting the money into the 529. The kid doesn't pay tax on the money either, right? But the beauty of it, everyone, is that money eventually goes to keep the kid from having to borrow a huge amount of student loans and things like that, and you're helping the kid or the grandkid. So all of that is on this slide, everybody. It's another gifting strategy, all right? So let me just show you what I've done so far. Push, pull, long, 23, 24, 25. Income tax rates are most likely going up in 2026. Estate tax, everybody, the exemption is going down on 1/1/26. Gifting, everyone, is a way to use up that estate before 1/1/26. All right. And I've already talked about this slide. And finally, look at this. The last thing, charitable giving. So the tax law of 2017 raised the amount that you could give to charity every year from 50% of your adjusted gross income to 60%, all right? And it goes back down to 50% again, starting 1/1/26. So everyone, the Tax Cut and Jobs Act, which was a Trump initiative, all right, did a lot to help people lower their taxes for this 8-year period of time. But absent any changes in our tax law, the things I've talked about revert to their pre-18 rules in 2026. All right, another issue, everybody, real quickly, is the qualified charitable distribution. Now, I'm just telling you right now, there's just a lot of discussion in the financial planning circles about what people with money can do to help others, to lower their estate taxes, things like that. And I'll get into the more normal things in just a minute when I get into my top 10 tax maneuvers, all right? But one more thing on higher net worth individuals. It is possible to give every year $100,000 out of your IRAs to the charity of your choice, all right? Humane Society, everybody, churches, schools, things like that, all right? Now, to do this, you have to be at least 70 and a half years of age. And you know, the realtors are getting younger, everybody, but still, I wonder what the average realtor age is in NAR right now. And last time I saw it is in the mid-50s or something. So as we get older, all right, if you have money that you want to give to charities, you're allowed to give up to $100,000 a year to the charity of your choice, all right? Now, the beauty of this is it reduces your net worth for all the things I've talked about here. So if you're worried about estate and gift taxes and things like this is something to think about. This is a big issue in financial planning circles. So you have to be at least 70 and a half, all right? There's no income limits. You can use it against your required minimum distributions that people don't like necessarily to take. You get no deduction for this qualified charitable distribution, but you don't have to pay tax on it either. You're taking it from your IRA, you're giving it to the charity in a certain way, everybody, direct transfer or carrying a check. Again, you get no donation for it. You don't have to pay any tax on the money coming out of your IRA. But in a nutshell, what it allows you to do is it allows you to give money from your IRAs to the charities of your choice while you are alive, as opposed to leaving it to them at your death. Now, the one tongue-in-cheek, everybody, you know me, I have a weird sense of humor. It's got me more trouble in my life than you can think about at different times, right? My sense of humor. But the issue here is the presumption is that you've already taken care of your children and your grandchildren before you start leaving a lot of money in your IRAs to the charities of your choice, which obviously your children and grandchildren, while you may think they're charities, they're not charities per the IRS. So anyway, there you go. All right. So anyway, churches, schools, everybody, museums, any 501c3 charity is who you can do this with. All right, here we go. All right. Now, everyone, back to some really, really good issues. And I've been all over the country teaching these 10 most significant real estate issues in taxation in 2023. All right. And I've been living coast to coast as far north as Alaska teaching this. So I'm going to go through every one of these in detail, everybody, but at least get a feel for this. So depreciation 179, good. The 20% qualified business income deduction, good. The Augusta rule. There's been so many things happening even currently in these things, right? Cost segregation studies, big. The S corporation, something I've been preaching along my entire career, but in line with number 2, the 20% qualified business income deduction, this is big. Number 6, the 1031 exchange. I'll talk about that. Number 7, the real estate professional status. If you own rental real estate and you have losses in a year, from what, everybody? Maybe from number 1, depreciation, maybe number 4, cost segregation studies. You need to qualify as a real estate professional in order to deduct those losses. And the definition is very specific. And I have a friend of mine, everybody, on this webinar, that she and her accountant and I had a discussion one day that he didn't feel she was a real estate professional from the tax standpoint. All right. It had nothing to do with being a good realtor. All right. This is a tax definition, and I'll talk about it. All right. Number 8, everybody, stepped up basis. The fact that death is one of the greatest tax benefits. Death is good from a tax benefit. I'll give you an example of that. Number 9, as a certified financial planner, I have to impress upon you the need to create an exit strategy from this business. And you got to have a nest of assets, everyone, on which to base your retirement on. No ifs, ands, or buts. So is it stocks, mutual funds, real estate, rentals, whatever the case may be? For you heavy hitters in the business of real estate, you at least ought to give a look-see to the cash balance defined benefit plan, although I will cover the conventional SEP IRA and the 401k as well. And then finally, number 10 is something I want all of you to think about. I'm going to cover this today. The pass-through entity tax loophole, which is relatively new on the tax ocean. And 37 to 40 states have now adopted this, and chances are your state has adopted it too. I was speaking in Iowa just earlier this week, and Iowa had just come on board with this, I think, in August of this year. So food for thought, check it out. All right, so here we go. Now I'm going to go through these 10 points, everybody, in my remaining time. So look at this if you would. And you're not here to become accountants, and you're going to get a copy of my PowerPoint presentation. Don't hesitate to show this to your accountant. So the title of this is the Section 179 deduction and bonus depreciation combined. All right. And then look at the three boxes. Okay. First, the orange box. For those of you with commercial rental real estate property, so warehouses, everybody, storage, restaurants, bars, the buildings, all right, the buildings. The 179 deduction in 2023 is now as high as $1,160,000. And if you want to, you can write off the cost of a new roof on a commercial building, a commercial real estate roof, or the HVAC, everybody, the chiller on top of the roof, security systems, alarm systems, things like that. All right. So theoretically, if you had a $400,000 new roof put on a commercial building, a small commercial building, your choice would be to depreciate that $400,000 over a period of time, or to write the whole thing off in the first year. Now, the mauve box, or whatever you want to call that, somebody wants to tell me what color that is. All right, I'm not good on colors. But now we're talking about residential rental property. This is my specialty, everyone. So now, instead of depreciating everything you see in that middle box over 5 years, which we had to do before 2018, now we can choose, everybody, to write it off the first year instead. And that means, everyone, appliances, ceiling fans, floor covering, whether it be ceramic tile, carpeting, whatever, blinds, outside equipment, mowers, snow blowers, trailers to haul, pickup trucks to haul the trailer, et cetera, et cetera. And I will tell you that in that middle box, everyone, I have every one of those is an item of personal experience with Kay and I, my wife, where we have written it off in the first year instead of depreciated over 5 years. And that's cool, cool, cool. And then look at the gray box, if you would. So, this is all good, everybody. It's all good. But your accountant may say, well, that's really good from the federal standpoint. And Chris is right. All right. But the state of blah, blah, blah doesn't like it as much as the federal government. So we may be able to write it off on the federal return, but we have to depreciate it on the state return. But I can't, it is what it is. All right. Your accountant would know that better than I, what the state issue is with regard to either 179 or bonus depreciation. But I'm telling you that in real life, everybody, every year, Kay and I spend X amount of money between 22 rentals, all right, on new appliances, everyone. I mean, they just don't last like they used to. And just in the last 2 weeks, I bought a new dishwasher, a GE Profile, installed for $935, all right. I bought a new garbage disposal, installed for $225 last week. And let me guarantee you this, I write that stuff off under the middle box here, everybody, because I can, all right? And our marginal tax rates are high, so I get the most benefit of those deductions. All right, that's number one. Now, everyone, the qualified business income deduction is an absolute gift from Congress, a gift from the previous administration, effective for an 8-year period of time, 2018 through 2025. All right. This baby goes away in 2026 unless Congress would extend it again. All right. Now, the previous administration created this. The current administration goes along with it and didn't change anything, which is good. All right. Well, what it means, everybody, is this. If you're self-employed, okay, this is what this benefits. If you're self-employed or you own rental properties, all right, then your profits are entitled to a 20% deduction of the profits. So if you're a realtor and your profit is $100,000, your deduction is 20 grand. If you're a realtor and your profit is 50 grand, your deduction is $10,000. One more example. If your profit is 300 grand, your deduction is $60,000. 20% of 300 grand, give or take. All right, there's always give or take in tax law. But here's why I'm bringing this up. Everybody gets this deduction. Almost every business out there gets this deduction, not just realtors. But the problem comes up. Look at the overhead, if you would. Look at the third bullet. All right. If your taxable income on a joint return is over 364 grand, well, one more time, here we go with the higher incomes, right? If your taxable income is below 364, married, everything I've said is true. But if your taxable income goes over 364 or single, 182, all right? 182 is single. So the 364 is married filing joint and the 182 is for single, all right? Then we got special problems, right? Because they don't want people making over those numbers based on their filing status to get this deduction unless they're willing to jump through hoops, right? And about here are the hoops. Once you get over that 364, I'm explaining this, everybody, or 182 if you're single, you need to be an entity paying yourself a wage. For example, an S corporation, all right? So let me give you the catastrophic mistake. So I'm in Phoenix, everybody, last week, and I'm meeting realtors whose GCI on a 1099 is $1 million or more, all right? Their GCI, gross commission income on their 1099 for 2022 is over $1 million. And they're filing their return as a sole proprietor, right? And they have very little wages paid to their team members. They're treating most of their team members as independent contractors. And let me just tell you what, everybody, they get no deduction because they get none of the 20% deduction. That's what I'm talking about here, the 20% deduction. They get none of the 20% deduction because once you're over 364 married or 182 single, the deduction is limited to 50% of the wages you pay. So let me just give you a prime example of what I would do with that client, all right? And I'd have done for him back in 18. Let's just say that they're making $1 million even in GCI. And their profit, everybody, would work out to about $600,000. 100 million minus 400,000 of expenses, and that leaves about 600,000. All right. Well, they got no employees. Let's assume that with me. All right. So they get no QBI deduction. I'd have them pay themselves at least a $200,000 salary out of that 600,000. I would make them into an S corporation. I'd have them pay themselves a $200,000 salary. And the deduction, everybody, would be 50% of the 200,000, which would be 100 grand, which would clearly save them at that level. Everybody, I'm kidding. I'm not kidding. 25 to 30,000 bucks in taxes. And in my opinion, it's almost malpractice, everybody, for an accountant that understands this 20% qualified business income deduction to leave that realtor making $1 million of GCI, a sole proprietor, and not putting them into an S corporation. So that's my explanation. Now, below the 364 of taxable income, or 182 if you're single, this discussion of the S corporation is not as important in respect to the qualified business income deduction. All right, meaning that you don't have to have wages paid to yourself, everyone, meaning that if a realtor had a $300,000 net profit on Schedule C, married, right, and their net profit was 300, and their spouse made a $50,000 W-2 job, all right, then they get the full 20% on the 300 because the combined taxable income would be less than 364. So, again, it just depends. But let me tell you what I see happening, everybody. I see happening is, go with me on this. A realtor with a Schedule C has a $200,000 profit, and their spouse, everyone, is a medical doctor making 500 grand a year. 500 plus 200 is 700. 700 is more than 364. And if they don't pay wages from that Schedule C, they get no 20% deduction. Sorry, I've got an itch in my left eye, everybody. Pardon me. All right. Okay. Now I move on. Now watch this. All right. The Augusta rule. And if you get bored with me talking, or you've got a glass of wine in your hand sometime and you want to have some interesting reading, just type into Google or Safari this Augusta rule. All right. And this has been in the Wall Street Journal more than you would think, and just in the last couple of months. All right. So look at the board, if you would. If you rent out your primary residence during the year for a period of less than 15 days, the rent is tax-free. Think Masters golf tournament coming up, which obviously is April, everybody, Super Bowl, All-Star games, et cetera, et cetera. All right. Over 1,100 homes in Augusta, Georgia go in the rental market each year. The average rent for the 7 to 8 day period is $15,000. I was doing a seminar for Market House Realty in Augusta, Georgia. There's a shout out, everybody. Market House Realty in Augusta, Georgia, a couple of summers ago when I got introduced to that 1,100 homes. That was pretty cool. All right. So now think outside the box. How about renting part of your home to your S corporation or partnership each year for monthly or quarterly board meetings? And my authority for telling you this, everybody, is IRS private letter ruling. You can see the number on the board. There it is, dated 10/30 of 80, almost 46 years, 43 years old now. All right. Talk to your tax professional. All right. And your tax professional go, oh, no, that's just too aggressive. That's too aggressive. Well, watch this, right? Watch what just happened. All right. So here is an article out of my Kiplinger tax letter this summer, everybody. All right. So they talk about the exemption is primarily about Augusta, right? But think Super Bowl, a rock concert, a presidential inauguration. This comes from Kiplinger tax letters. And then a recent tax court case in summer of 2023, the Sinopoli versus Commissioner. This is a brand new tax court case, permitted a twist on this strategy, all right? It allowed 3 business owners to rent their homes to their business for meetings, deduct the rent, and receive the rent-free, tax-free under the master's exemption, the so-called Augusta rule. But the owners must follow all the rules, and these 3 didn't. Right, here's humor, right? My tongue-in-cheek humor, right? These 3 paid themselves a total of $300,000 over a 3-year period of time and said, that's deductible by our entity and tax-free to us. And the IRS says, we don't have trouble with you doing it. We just have trouble with the amount of rent that you charged. All right. And through the court, everybody, the court held that of the $100,000 a year they paid themselves, only about $11,000 or $12,000 was reasonable. So the court said, what you're doing is fine. It's the amount of money that you tried to deal with is not fine. So that's where they didn't follow the rules. So by this case backs up the previous slide that this is legitimate as I am standing or sitting in front of you today between the private letter ruling back in 1980, this number 81, and the Sinopoli case in 2023, everybody. No accountant worth their salt should back you off of this, nor should you allow them to do this. Think about it. But you must be an S corporation or a partnership in which to do this. All right, now, In terms of depreciation, class, obviously, absolutely, the biggest thing going right now in large commercial real estate purchases, acquisitions, ownership, and the same with large complexes of residential rental is the cost segregation study. And take a look at the slide here, if you would, from left to right. All right. This is the real ticket to accelerating depreciation deductions on large commercial or residential rentals. The objective of a cost seg study is to take from the 27.5 or 39-year life of the building, everybody, 27.5 for residential rental, 39 for a commercial, and to take as much of the building out of those two lives and put it into the 3, 5, 7, 10, 15, and 20 year. Because whatever you get into those 4 categories or 5 categories is not only depreciable over a much shorter period of time, but it also is deductible in the first year if you decide to do that. All right. So look at the next box. The result is a significant deduction attributable to faster depreciation of the short-lived assets, and a current deduction for the fast and the missed depreciation in earlier years. You need to contact a cost seg company. They're not cheap, everybody. The cost seg studies are not cheap, but few complain about the cost when they see the tax savings. 2 examples. Hear me out on this if you would. I was in Sun Valley, Idaho. Sorry, all right, about a week and a half ago, and a young woman in one of my investment classes told the group that she had just had a cost seg study done on a building in Idaho that cost her $384,000. The cost of the study was $2,500. That was out of her pocket, which is deductible, all right? And the immediate tax savings was $12,500, a 5-to-1 return on her money, all right? And that's kind of on the low side. It can be 7 to 10 to 1. And then I was in Phoenix, Arizona within the last 10 days, talking to one of those realtors, everybody, that was hitting $30 million a year in volume, right? And she told me that she reduced her current tax to 0 in the current 2022 year, right? Because she had a cost seg study done on 3 or 4 of her commercial buildings. So everybody, I'm just telling you, this is a big ticket item. And if you own valuable commercial or residential rental, you ought to talk to your accountant about having a cost seg study done. All right. It is maybe worthwhile. All right. Now, class, I'm just as high on the S corporation as I ever have been, with the only degrading issue now is that darn Corporate Transparency Act issue that I opened with today. But the S corporation, through the reasonable salary versus the distribution, I start teaching for Auburn tomorrow, everybody, and this is a big issue for accountants again. How much is a reasonable salary? Nobody has a clear answer to that, just a lot of guesses, but nobody has a clear answer. But we have the opportunity to reduce our Social Security taxes, and let me show you how, all right? So look at this if you would. In 2023, let's just assume that your profit from your business of real estate is going to be $300,000, your profit. And that might equate everybody to $500,000 of GCI, whatever, right? So this is just an example. If it was $100,000, it'd be different numbers, all right? Anyway, if you were my client, I'd have you take about $130,000 salary out of that 300, meaning you'd have 130 of the 300 as salary and the other 170 as distributions. You're still going to pay tax on the full 300, income tax, but you're only going to pay Social Security tax on the 130, which comes to exactly $19,890. These are very exact numbers, all right? By the way, all right, you're also going to get more of the qualified business income deduction, presumably, because if this person were single, all right, and with a 182 number, remember that earlier today, right, that $130,000 salary would get them roughly a $65,000 qualified business income 20% deduction, right? But if they were a sole proprietor, right, they would not get any of the qualified business income deduction because their income is too high. All right, so watch this. Now back to the S corporation. So you're going to owe $19,890 of Social Security taxes. Ignore what I'm saying, everybody. Ignore what I'm saying. With a $300,000 profit, your Social Security tax will be $27,899 if you stay a sole proprietor or an LLC taxed as a sole proprietor. So doing what I say, everybody, is going to save you $8,000 a year, right? Plus gets you the qualified business income deduction. Only negative point is that corporate transparency report. And then look at the bottom box here, if you would, the bottom paragraph. Note, however, that the current administration in Washington has put this issue, right, on the IRS radar, but this has been supposedly been a target for my entire career, and we have not seen much IRS interest if reasonable salary is claimed. But don't press me for what reasonable salary is. Nobody has a good answer for that. But I believe my 130 on the 300 is. All right. So 3 quick takeaways on the 1031 exchange as I'm moving through my material, everybody. All right. So the 1031 is now 100 years old, over 100 years old. In the gray box, like-kind exchanges are far from being only for the wealthy. And the gold box, the great majority of properties being exchanged probably would not be sold if tax was due. And nobody knows that gold box, everybody. That's a presumption, right? But I will tell you this, I'll give you some hard facts. Kay and I sold a Tucson, Arizona property on July 15th of 2022 that we had paid originally about $170 for, depreciated it way down, everybody, and sold it at the top of the market in Tucson, Arizona for $369 on July 15th, 2020. We fully planned to do a 1031 exchange, the 45-day identification, the 180-day close, and Kay came down with full-blown COVID right during this whole thing and almost died. She's fine now, made it through it. But everybody, suffice it to say that my thought was not on taxes and money for a 50-day period while she was in the hospital. We paid $51,000 in federal, Arizona, and Illinois income taxes on that sale. That's what happens when you don't do a 1031 exchange. All right, now listen up if you would. Now, so Joanne Fraser, good friend of mine who's on this call, all right? And her accountant, everybody, is Richard X out of Cupertino, California, somewhere out there, right? And Richard owns a lot of rental real estate. And his comment to me this summer when I did a class in Monterey, California, was that how can any realtor, everyone, who's owned rental property for a number of years be losing money and have a loss on Schedule E? So he didn't think this was that relevant. But I got to make a point. If you have if you are taking advantage of my number one significant issue, all the tax write-offs through depreciation and or cost segregation studies, it is extremely likely you could have a loss in a given year on Schedule E of your 1040, everybody. And then here's the deal. If you are not a real estate professional, you may find that that is not deductible. If you are a real estate professional, it is deductible. Simple as that, all right? So look at the board, if you would. Look at the overhead. Losses from rentals on Schedule E can offset commission income. Huge, right? Here are the 3 tests to be a real estate professional. Before I go through the 3 tests very briefly, let me just say this. You don't have to be a realtor, everybody. You don't have to have a real estate license. You don't have to belong to NAR, right? You just have to meet these 3 tests. Number 1, the 50% rule. Of all the time you spend in all businesses during the year, each year, you have to spend more than 50% in the business of real estate, all right? Number 2, number 2, you have to spend more than 750 hours in that business of real estate during the year. And number 3, you need to manage your own rental properties. This is called the material participation rule, all right? So, all right, those are the 3 rules. And let me give you a prime example before I walk away from this particular thing. So everyone, Kay and I typically have profits on our Schedule E, all right? But when we upped applianced a bunch of our rentals a couple of years ago and wrote off 66 grand, everybody, a brand new GE profile appliances, we had a loss, right? And we deducted that loss because we qualify as real estate professionals. But a good friend of ours, he is a doctor in town and his wife's a nurse, and they own a bunch of rentals as well, all right? They don't meet these three tests, everyone. They don't meet the first test, right? They could meet the second test. I doubt it, but they could. And they clearly meet the third test, but they don't meet the first test. And it's an and test. It's all three, yes or no, all right? You blow one of them, you miss it, all right? So Patty and I, his doctor's wife and I, sometimes our personalities grate on each other. And when that happens, everyone, I'll just remind her that Mike needs to divorce her as a nurse, marry a realtor that meets all these tests, and now Mike will be a real estate professional. And ladies, don't jump here. That's humor only. And I usually get the response I want, and then we move on. All right, but there it is. All right. Okay. Now, everyone, look at this if you would. Then I've got an example. As I get toward the end of this, stepped up basis, and remember, I'm going to about probably another 10 or 15 minutes, and I'm cutting open to questions. All right. So if you're holding on for a question, please hold on. So stepped up basis class is really a good benefit, but unfortunately a person has to pass on, and you have to be the heir to benefit by this. So a good friend of mine lost her husband in the last year, Sandy Nichols, everybody, the hat realtor from either Alabama or Georgia. I always get them mixed up. But she was in a class of mine I did for Star Power in Denver over the summer. And I apologized to her before and after the presentation about speaking about this. And she totally got it. All right. So it is what it is. But here's the deal. Death is good from a tax standpoint. So look at the three boxes left to right. For inherited property, other than tax-deferred investments like IRAs and pensions, the new tax basis to the inheritor, the recipient, everybody, is generally the fair market value at or near the decedent's date of death. And every one of my 97 people on this webinar have probably been asked to do a BPO, everybody, a broker's price opinion on a piece of property at or near the death of the owner of the property for this purpose, all right? Middle box. This is one of the most significant issues of both federal and state income taxation. This is the way, right box, that fortunes are left to individuals when inheriting property from decedents. Now, watch this example, everybody. Look at this example, please. So Dad bought a rental property, everybody, over 20 years ago for $200,000. And over the last 20 years has written this thing down to $50,000. Dad has benefited by claiming all this depreciation over a 20-year period. All right. So his basis is 50 grand. Now, Dad passed away and left this to you. And the fair market value roughly on the date of death, everybody, was 490 grand. Your tax basis in this property is 490. You sell this for 490, tax-free money. You keep it and rent it out, everyone. You would then start with a cost basis of 490, allocate the land away from it, let's say $40,000, and start depreciating that whole thing all over again. So the beauty of this is all the depreciation recapture that Dad would have paid that had he sold it, all right, simply is forgiven because of death, and the heirs receive a stepped up in basis. Now, I will say this. If Dad had gifted this to you while he was alive, everyone, let's say 6 months ago, well, his 50 grand basis becomes your 50 grand basis. And all Dad has done there is he's given you a piece of property worth almost $500,000, but he's passed on the tax cost to you as well. All right. So, food for thought. And don't forget that the current federal estate tax, a segue back to something earlier discussed, is $12,920,000. And assuming that Dad has a value of his estate of nowhere near that, all right, he would have no federal estate tax on this issue. All right, it is what it is. All right, now something, everybody, that just happened earlier this year, just so you know about it. Estate and gift tax attorneys were pushing a loophole, all right, using an irrevocable trust or an irrevocable trust, however you pronounce it, where they would set them up, and they were called intentionally deficient grantor trust, an IDGT, intentionally deficient grantor trust. Now, you're not here to become attorneys, so just hear me out on this if you would. But what the attorneys were doing, everybody, by setting up this grantor trust that was irrevocable trust, all right, they would set it up so that that it was out of the decedent's estate when the decedent died, yet the heirs to the assets of the trust would get stepped up basis as if the asset was owned by the decedent at the date of death. And it was done through a process of creating the trust with language that made it intentionally defective. All right. Well, if it sounds too good to be true, it is. And early in 2023, the IRS issued a revenue ruling 2023-2 that said enough is enough, right? These intentionally defective grantor trusts will no longer allow the ultimate heirs of the property to receive a stepped up basis, all right? And the theory of the IRS, everybody, was that the assets in the trust were not owned by the decedent at the date of death, and therefore the heirs don't get a step up in basis. So here's the deal, right? If you are a beneficiary of one of these intentionally defective grantor trusts, you might want to give the attorney that wrote the instrument up and talk to them, everybody, because here's what we accountants are going to see in the next couple of years. We're going to have one of you come in, and you will have sold an asset that was distributed to you from a trust, all right? And you've been told by somebody that you get a stepped up basis in this, right? And then the accountant, to protect their own license, is going to, I know I will, right? I will say, prove to me that this is not an intentionally defective grantor trust. And if I need to talk to the attorney that wrote up the trust document, then I need to talk to them. All right. So anyway, that's the issue. The IRS put their foot down on this, everybody. It was too good to be true, so therefore it is. All right. Now, here is the theory of the cash balance defined benefit plan. And I'm going to delve into regular retirement plans as well. But I'm telling you that if you are making 500, 600, 700 or more GCI a year, right, and you want to put away mo money, everyone, mo money into a complex retirement plan that allow you to put away mo money, well, here it is, all right? And I will tell you this, and some of us go back, everybody, to Howard Brinton days when he was a mentor of mine and I was a speaker in 18 of his 19 annual conventions, all right? Missed one because of a CRS convention. But several of his stars have come up to me in the last couple of years and said, because I introduced them to this concept, that's all I did, because I introduced them to the concept, and then they found the advisors to help with. I introduced the concept. They were now retiring with over $5 million in their retirement account, all right, because of the cash balance defined benefit plan, which enabled them to put away mo money each year. So go left to right, if you would, right? For the high income and disciplined self-employed person, allows for tremendously higher contributions and deductions, mo money, than the SEP IRA or the 401k. More expensive, bottom. Many people shy away because of the required higher contributions. They lack discipline, all right? And finally, the concept is based on filling the retirement cup to pay out a significant amount per year in retirement. That's the theory of this, everybody. You're allowed to put away, for example, if a SEP IRA has a limit of 66 grand, and I'll show you a chart of this in a minute, in a year, into a contribution for a SEP IRA, which would be tax deductible. these things can allow you $150,000 to $200,000, depending on your age, accumulated wealth right now, things like that. All right, talk to a financial advisor about this if you're interested. Now, take a look at this if you would. The pass-through entity tax loophole. So since 2018, and I'm going to make sure I didn't skip one. Okay, since 2018, we have had a limitation on our 1040s on our itemized deductions, Schedule A, that we could deduct for SALT, everybody, state and local taxes. SALT, right? That's what it's called, SALT. And I'll just give you a prime example of this. I live in a high income tax state, Illinois, and my state income taxes are $15,000 typically, right? A 5% tax, all right? Now, let me go one step further. Then Illinois is the second worst property tax state in the country, only second to New Jersey. And this hit in the last couple of weeks. Everybody, we're always in the worst 5. Well, now we're number 2. All right. And our property taxes on a $700,000 home on 3 acres, Joanne Fraser, 4,200 square feet on 3 acres, $700,000 are $14,000 a year. Right. Add them up. 15,000 state income tax, SALT. Property taxes, everybody, on a principal residence, local taxes, 14. That's 29. And then our real estate taxes on a beautiful second home in Fort Myers, Florida, another $6,000, everybody. That's 35 grand of SALT. That before 2018, we were able to deduct on our federal return. And after 25, we'll be able to deduct on our federal return. But for an 8-year period of time, we're only allowed to deduct $10,000. All right, SALT. All right, so look at the blue box. This pass-through entity tax loophole was introduced by the states, now 37 to 40 states. All right, I'll show you a list, a partial list in a minute. All right, to allow us to work around the SALT limitations, and Congress, or at least the IRS, went along with it. IRS, not Congress, but IRS went along with it. So the blue box. This is a direct workaround to the $10,000 SALT limitation, is literally a gift from the IRS. It requires, the green box, the cooperation of your state of residence. I'll have a list of them in just a minute. For example, IDOR in Illinois, right? And a lot of us were surprised that Illinois went along with this. Now, look at the 3 boxes left to right. This is the pass-through entity tax. I want all of you to call your accountant. Are we taking advantage of this? And by the way, tongue in cheek, if you live in a no income tax state, Nevada, Texas, Florida, etc., you have no play here, everybody, because you have no state income tax. Sorry, right? But look at left to right. Basically, it allows your S corporation or partnership. You have to be a pass-through entity. A sole proprietor is not. You have to be a partnership or an S corporation. It allows that entity to make an estimated tax payment of your anticipated personal state income tax due on the profits of your S corporation or partnership for the year. Middle box. The rule then allows your entity to take a deduction for state income tax paid on its tax return, which reduces your taxable profit from the entity at the federal level. And the right box, everybody, this loophole, totally legal, totally legit, is worth thousands of dollars in tax savings. And in my case, has saved me over $3,500 in both 21 and 22 and 23 and will in 24 and will in 2025. All right. And the more people I talk to in all my seminars, the more of them are aware of this, everybody. And that's good, good, good. So here's the deal. If you are a S corporation or a partnership, and in one of the states that I'm going to show you just now, you need to be talking to your accountant. So here are the ones that adopted this in 2021. In the upper left-hand corner, everybody, Alabama, bottom right-hand corner, Wisconsin, and everything in between. All right? And you'll notice Illinois in the top right-hand column. Now, what about the states that adopted this in 2022? Well, here's the next group of states, all right? Upper left-hand, everybody, Arkansas, bottom right-hand, Oklahoma, and all those states. So again, these states adopted it in 21, all right? So I got it in 21, 22, and then 23, 24, 25. These states went through it in 2022, and the point I'd like to make to you now is more states are coming on board. A friend of mine, Dan Aarons out of Iowa, looked this up yesterday when I was there, and Iowa, everybody is going for this as of May of 23, if I'm not mistaken. So you won't see Iowa here anywhere on the list, but more states are coming on board. Check with your state. All right, very good. Now, in starting to wrap this up, everybody, just look at this, if you would, just a couple of good things here. So I'm done with my top 10 things. And pardon me, I left my phone on for a very specific reason, and it's a robocaller. Good. Sorry about that. Very rude. Anyway, orange box, consider the S corporation status versus sole proprietorship. I've done that. All right. Number 2, everybody, hire a good, competent CPA or EA. Number 3, this time of the year, do not let the tail wag the dog. Don't do something stupid to save taxes that does not make sense for your business. For example, your vehicle is running fine. Your vehicle is reliable. Don't go out and buy some $80,000 SUV because it's going to save you a bunch of taxes. Yeah, it'll save you a bunch of taxes, but is it really worth it to spend the money on that right now? Number 4, prepare or have prepared a monthly cash flow. Class, stay on top of your money. No ifs, ands, or buts. Real estate is a business where you can spin yourself into oblivion in a heartbeat. I see it every single year, buddy. And then you come up to a downturn in the market, like some of your markets are. And then all of a sudden people going, wow, what happened to my business? All right. So, you got to plan for when things are not as good as they are. Anyway, number 5, in the green, keep your expenses in line with your income, and then plan what you're going to do with the money. All right, what else? Get your records organized. Do not fudge on income and deductions. Check and double check. Do not wait until the last minute. And the key to this is have a good tax professional. All right, and what I'm doing, class, now is I'm just going to take about 5 more minutes and run through my remaining slides rather quickly, but you get them all right? And then I want to open this up to about 30 minutes of questions and make sure that you get your questions answered. Remember this: entertainment expenses are 0. All right, you cannot deduct any entertainment expenses, and your meals were 100% deductible in 21 and 22 business meals, and in 23 are back to 50% of business meals. Entertainment 0, business meals 50%. All right. So what you want to do, class, is realign what some people would call entertainment, work it into advertising and promotion. For example, if you're going to take 20 people out, everybody, on a boat for a tour of the lake and all this good stuff, have a banner made about your listing presentation, time on market, list price to sale price, all that good stuff. Make a presentation and write off the whole thing. If you're going to take a group of people to a nice restaurant, rent out a part of that restaurant, a private room there, do a presentation, class, and write the whole thing off. And then I don't mind give examples. I tell this gentleman, I use his name all the time, but a very successful realtor in our market, Champaign-Urbana, Scott Bechtel, all right? He will, he knows I talk about it, but he will rent a movie theater several times a year, class, and his world just reserves different slots of that same movie during a 12-hour play period, playing maybe 5 times. And his world comes through there, those who want to see the movie. And between each movie, he's up there and giving a presentation about his business and thanking them for their business, et cetera, et cetera. And I'll guarantee you this: I'm not his accountant. He's not a client of mine, so I can speak about this. I got to believe he's writing off 100% of that, not as entertainment, but as marketing or promotion. So that's what you do with your client appreciation events. Now look at this, if you would. Whether you know this or not, most of you do not deduct your charitable contributions because statistically, most of you do not itemize your deductions. So your partnership, your S corporation, and your sole proprietorship cannot deduct charitable contributions as a business expense. Only the C corporation can do it, and very few of you are C corporations. All right. So my point is instead of writing checks for contributions out of your business checking account, which most likely become non-deductible at the end of the year, do sponsorships instead, everybody. Sponsor a golf hole at an annual charitable event. Sponsor bingo, everybody, at your church, synagogue, or mosque, everyone, and buy the poster that goes across the stage and all that good stuff. But restructure it so it's not clearly a charitable contribution, but it's advertising. All right, food for thought. All right. Now, retirement savings, and this is where I'm going to end this, if you would. I'm going to show you just a chart real quickly. Everyone, what is your exit strategy? I implore you to think about this, all right? And, I get hired by companies all over the country, class, and usually they want me for 4 hours on tax strategies and a couple of hours on this kind of topic. What's your exit strategy? So look at the board. So you've got in 2023 the limits of what can go into these various plans. And I'm not going to show you or read to you what it says. All right. But then if you are 50 years of age or older, nicknamed the geezer rule, at the bottom, you can put in more money. All right. Well, all I want to do in leaving you is show you this. All right. Here's a chart about what you can put away into a SEP IRA a year or a 401k for a year. And here's what I want you to do. I want you to ask your accountant when they're getting ready to do your 23 return to calculate the limit of what you can put into your SEP IRA or your 401k for 2023. And then ask them, after they give you the number, how much taxes will it save you? That's what I want you to do. So I end with this. Look at this, if you would. I have 3 charts, everybody, three columns, trying to get to as many of you as I can. I have a $50,000 chart, salary or profit from your business, 80,000 column, and a 220. And then go to the bottom of each column. If you make 50, you can put in 10 to 12,000 tax deductible into a SEP IRA. You make 80, 16 to 20, you make 220, 66 grand. All those numbers across the bottom are tax deductible. All those numbers are the limit. Anything less than that is allowed and is deductible. Now go up to the third row from the bottom. If you have a 401k, you can put away more money, all right? 35 grand versus 10 to 12, 42.5 versus 16 to 20, 66 grand is the same whether or not it's a 401k or a SEP IRA. But if you're 50 years of age or older, then you get another 7,500, and that's the second row from the bottom. And that would be 42.5, 50,000, and 73.5. Every number below the line is the limit and is deductible. Anything lower than that you wanted to put in would be totally permissible. And let me leave you with one thing, all right? Then I'm going to take questions. So what if you were making 80 grand, everybody, profit or salary from your S corporation, and your accountant tells you that you can put between 16 and 20 away tax deductible, and it's April the 1st, all right? And the accountant says, have you got the money to do it? He said, your number is 18 grand. Have you got the 18 grand? No, I don't. All right. That's what you're going to, let's say you have to tell them that. And then the accountant should say, will you have it by October 15th of 2024? And you answer, yes, I will. All right. Because everybody, your accountant can get you an extension of time to file until October 15th to fully fund how much you want to put into your SEP IRA for the year. All right. Food for thought. So everybody, let me just tell you what I'm doing. Now, I've got more slides, and I need another hour to go through these things. I always have more material, but let me tell you what I'm not covering, okay? So in late 2022, Congress passed the Secure Act, which helps people put away more money for retirement, not take it as soon, things like that. All right, that's the Secure Act. Now, the last part of my material that I'm not going to cover, but I want you to look at this on your own and even share my slides with your clients. But there are really cool tax credits for your principal residence and your second home, all right, for the next 10 years, 2023 through 2032. The $1,200 of credits replaced a $500 credit that's been around for years. And all of this information comes from EnergyStar.gov. So take my slides, everybody, look at it, share them with your clients. I'm one for telling realtors that bring value to what you do for a living, and give them good information. You're not to become an expert about this, but I would look at it myself for sure, just to get a feel for it. And the last thing in my notes, everybody, I just want to show you this if you would. There is an issue with the new clean vehicle tax credits, the plug-in electric vehicles or the all electric vehicles for a 10-year period of time. And I'm giving you this URL, everybody, in blue. If you want to see a list of all the electric and plug-in electric vehicles that qualify starting in 2023, there's the list, all right, at that URL. And I want to thank you, everybody, for your time. And I now am going to go to questions. And Paul, I'll pull off the chat if you want me to, all right? Or you can do it, all right? It's up to you, Paul. What do you want me to do?
Oh, either way, Chris.
Okay, well, I've got it. Okay, so I'm going there and I'm getting past all the hellos, everyone, and hello to all of you. All right. Sylvia Dukes from Florida, Mike Ring from Minnesota, Joyce Stewart from Florida, Carbondale, Colorado. Very good. I'm getting through there to go to the questions. Okay, here's the first question I've got. Hold on just a second here. A deceased owner held house in a trust. House was sold and only a small bank account is left. What is needed to close the trust out? Better in 2023 than 2024. Any warning information? Well, let me tell you what. I mean, there's so much I don't know. To the person asking me this question, I don't know whether that's a revocable trust, everybody. I don't know whether it's an irrevocable trust, but it's the trust instrument that dictates all of this. All right. So a couple of things. So deceased owner, the house was held in trust. Well, if it's a revocable trust, as if really the owner was still alive. If it's irrevocable, it's a newly created entity, everyone, and it has a life all of its own. Then the question goes on to say the house was sold and only a small bank account is left. Well, now my question is, what about the proceeds from the house sale? Where's that? All right. Because if that's already been distributed, well, that just raises a question. But theoretically, all right, the house sale should not generate a taxable result unless watch my hands, unless this was an irrevocable trust where the house was transferred in many years ago with the basis of this, and then the trust sold it for this. All right, then we may have a problem. So I just don't know enough information. I'm hoping that it was a revocable trust. And if it was a revocable trust, then theoretically the owner still owned it at death, everybody, and the trust gets a stepped up basis and nobody owes tax on it whatsoever. All right. But respect the fact that I need no more information. All right. Next question. Does this apply to oh, I love this one. All right. Does this apply to rental property overseas? Please, is the question. Well, what I don't know is what are they talking about in my material that applies? Does what in my material apply to rental property overseas? That I don't know, but I will tell you this. Fundamental tax law class. A U.S. citizen or a resident alien is taxed on their worldwide income. So if I owned a property, everyone, in Italy, all right, as a U.S. citizen, it is as if that property were located next door to me on an acre next door to me. That's how it's taxed on my U.S. tax return. And believe me, the IRS is very concerned about U.S. citizens and resident aliens owning property in foreign countries, because the feeling is, well, if the U.S. don't know about it, then why do I have to pay tax on it? And that's not the law. All right, I'm just going through the questions. Give me a second. I got it. This is always so touchy. Converting IRA to Roth IRA. You are paying taxes you don't really owe. At age 73, you only have to take out 4%. So older agents, okay, so everybody, this comes from my good friend Joanne Fraser, and here's her point, all right? As you age, all right, you start losing the benefit of the thought of converting an IRA to a Roth IRA, because you have less years of living to accumulate that tax-free money. So clearly, an IRA conversion to a Roth IRA, and I said this earlier, and a lot of financial advisors, everybody, are talking about this right now, and it's something to consider. And clearly, a person in their 50s or 60s would have more time than somebody in their 70s or 80s to accumulate money that will be tax-free. But Joanne, it's something not to write off at your age either, right? Because you're going to live to a ripe old age yet, Joanne. It's something to be considered, right? But I would never say never, right, to you on that point. If you do that, does it not reduce your Social Security income later? Okay, so everybody, so the question becomes, what are you referring to? If you do that, and I think I know what this person is referring to, but I'm on a little bit of a guess. All right, so let's hope I guess right. So there's always collateral damage, everybody. In fact, one of my worst fears in taxation and financial planning is somebody follows a bit of my advice, all right, but it literally screws them up down the road because they did something that it makes sense today, but down the road it hurt them another way. So what I'm being asked, all right, is if you do a conversion of an IRA to a Roth IRA, now watch my hands, everybody, all right, this raises your income. It raises your adjusted gross income in the year you do the conversion of the Roth IRA. So again, why would I do that? Because tax rates are lower now than they will be down the road, okay? That's why I would do that. However, now, if you're on Social Security, your Medicare A, B, and D premiums, everybody, are based on your income 2 years earlier. So and that's what happens, right? So, and the Social Security computer is apparently in bed with the IRS computer, so that in a year that you do convert an IRA to a Roth IRA, which raises your income, right? And let's say you did that in 2022. Well, everybody, 2 years later, your Medicare A, B, and D premiums could be considerably higher because they're income adjusted. And I believe that is what the person is asking me that question. And if not, my answer is still correct, whether that was the question she was asking or not. All right, here's another question. What do you know about the Delaware Statutory Trust? So never done one, never been involved, everybody, but here's what the DSTs are all about. So you've got people that own a lot of residential rentals. As they age, everybody, they're tired of bedrooms, okay, and all the problems of having people that, you know, month to month and year to year rentals, bedrooms, right? And they want to go to a less management intensive type of activity, but they don't want to pay taxes when they sell their residential rentals. So what they do is they do a 1031 exchange of their residential rentals into a DST, a Delaware Statutory Trust. And now, everyone, they go from a total ownership of what they used to own, the residential rentals, to a very small fish in a big ocean, owning parts of CVS's and commercial buildings and big apartment complexes across the country. And they go from labor-intensive management to annuity kind of investment, and it's totally legitimate. And the beauty of this Delaware statutory trust is they always have the properties for you to go into coming out of a 1031 exchange. For example, what if you're having trouble finding replacement properties, identifying and closing within the respective 45 and 180-day period? The DST offers a quick solution to that. All right. So I'm just telling you what they are, and I'm leaving it to you to caveat emptor. You do your own research on whether this is for you or not. All right. Personally, it's not for me, everybody, because I want hands-on. That's just the kind of person I am, but that's not everybody. All right, very good. So I know a lot about the Delaware Statutory Trust. Does this mean 750 hours in property management, or does a real estate broker qualifies? A real estate broker qualifies. A real estate broker's time qualifies. What you're talking about there is the real estate professional rule. And let me just describe the 3 tests. Again, more than half of your time in the business of real estate, and more than 750 hours in the business of real estate, and manage your own properties. And they want you to be spending at least 500 hours, everybody, between all of your properties a year to be proving that you're materially participating in your rentals. All right, here we go. And the Zoom just jumps around so much, everybody. I get skipped questions. What kind of trust do you recommend for property, revocable or irrevocable? Everyone, that is a question to your estate tax attorney, not a financial guy. All right, I'm not the guy. The attorney will simply ask you this: what are you trying to do? All right, everybody, just remember this. Revocable means it's still yours. All right. Irrevocable, it's out of your estate, everybody, and you may or may not control it anymore. So the attorney is going to ask you, what are you trying to accomplish? Self-directed IRA, all right? And I have 3 properties in a self-directed IRA. Self-directed IRA, can I pull out 100% and buy real estate instead? The market has been flat for the past 2 years, and this might make sense. How should I go about doing it without triggering a tax? Well, here's the point, everyone. You don't pull nothing out of nothing when you buy real estate with your self-directed IRA. You direct your self-directed IRA to buy the real estate in the name of the self-directed IRA. And the answer to this is you go to a good special asset trustee. And some of the big names out there, everybody, are Pensco Equity Trust, IPX, IRA Direct. I mean, do your research, but get with a good company. I use Chicago Trust Administration Services out of Chicago, Illinois. And my representative body is a Mr. Steve Miskowitz out of Chicago. And he is the one that administers my self-directed IRA. But you don't take the money out, you direct the direct IRA to buy the property. I move on, hold on. I have a question about 1031 exchanges. Can I exchange a property that's seasonal rental? Hold on. Boy, Paul, I just wish that, I wish this was not so sensitive. All right, I'm going to go.
If you want, I can read them off to you, Chris.
No, it's all right. I think I got it. All right. I own a rental in Florida. Can I move in and homestead it for 2 years and have the gain and the depreciation forgiven? Mike Ring, where have I seen you recently, Mike? This is Mike Ring's. Mike, where have I seen you? All right. A name rings a bell. Mike's been at a seminar of mine recently. All right. So Mike, I'm giving you a shout out. I own a rental in Florida. Can I move into it, homestead it for 2 years and have the gain and depreciation forgiven? Well, number one, by moving into it for 2 years, you now qualify for the 250 and the 500,000 exclusion. However, Mike, you never walk away from the depreciation recapture, all right? Otherwise known as unrecaptured Section 1250 depreciation. And then there's another issue there called the period of non-qualified use. So the appreciation on it while you didn't live in it when it was rented doesn't qualify either. So the answer is 1 yes with 2 no's, all right? And again, a complex tax question. For the most part, yes, but there's still 2 no's in there. You'll pay some tax on it regardless. I continue. 1031 question. The rental I have owned for 20 years, I'm thinking of selling for something at the beach in Maryland. Vacation rentals, May through September. Can I exchange a property I do for yearly rentals to seasonal? Absolutely. All right. If it's real estate in the state where you're selling it by definition, and it's real estate in the state you're buying it by legal definition, it's like kind. Can seasonal be transferred for annual rentals? Absolutely. All right. I have an S corporation business that I take a salary, and now I'm starting a real estate investing business as an S. Do I need to take a reasonable salary on this new business? I do not need an extra salary. Okay, now Susan, I don't know your last name, Susan, so I'm good on this. All right. But let me tell you what, I would really think twice about having an S corporation real estate investing business. Instead, I would probably make that real estate investing business an LLC that is not an S corporation. But let me qualify my answer. If you're going to hold long-term property in that real estate investing business, I don't want you to be an S corporation. If you're going to do buy, fix, up, and sells, it doesn't really matter, right? But if you're going to have long-term holds, my recommendation is you don't have any long-term appreciating property in a corporation, whether it be S or C Corp. Put it into an LLC instead. And then that will answer your question about the salary. I've heard there's specific wording in a trust that is required to protect the recipients of the trust from taxes. I have no idea what you're talking about. I'm sorry. I have no idea. I'm not an attorney, everybody, and that is not my field. If gross income is always 150 or less, and you're a sole proprietor, would you suggest another entity? I tell you what, if you're anywhere near 150, I'd have you an S. If you were my client and you were anywhere near 150 a year, you'd be an S corporation. That'd be my recommendation. Evaluation for today. Okay, Susan say it will be fix and sell. Then it doesn't matter, Susan. And now you're an S corporation. Okay, fine. But the IRS would look for you to take a salary out of that S corporation of the fix and sell as well. Can I hire you for tax advice and planning? Thanks, Tammy Durbin. Tammy, thank you for the compliment. Tammy, give me a buzz. For a quick answer, I'd be more than happy to talk to you. All right. And CRS has got my number. Chris, I was in one of your 2-day classes in the Minneapolis area probably 7 years ago. Excellent then, and even better now. Thank you. Yeah, but Mike, I've seen you recently. I just don't know. That's Mike Ring again, but thank you for the compliment. Okay, listen to this one. Here's somebody that knows, everybody. Bonus depreciation. All right. Bonus depreciation used to be 100% everybody before 2023. Now it's down to 80%. And Sharon is asking me, do I think it will jump back up to 100%? This might be a late year entry, Sharon. We will see. We will see. Hi, we signed. Okay, to that. I think I'm just going through again. I'm just going through my questions. There again, I got Joanne's question. Okay, I'm being asked, everybody, on my slide. There is a forced number, and I tell you what I'll do. Let me make sure I've got all the questions. As a real estate agent receiving commission on at 1099, is it okay to form an S corporation as long as a reasonable salary is being paid? Very few states refuse to allow a real estate agent to become an S corporation. The vast majority of states do. So not knowing where you are, Carter, I mean, I'm going to say, yes, it is. All right. Unless your state will not allow a realtor to be a S corporation. Okay. I was asking about being allowed to deduct roof, appliances, floor covering, etc. Oh, very good. All right. Back to Angela, everybody. If she has properties overseas, all right, she's allowed to take those same write-offs that I talked about and taught you today. The answer is yes, regardless of where they are. All right. There was a deduction for Social Security tax with an S corporation versus sole proprietor that saved you money now, but does it reduce your income later? Well, okay, so I think here's the question I'm being asked. All right. Everyone, watch my hands. If you go with the S corporation, no ifs, ands, or buts, you're going to reduce your Social Security tax. All right. And I think what I'm being asked by Connie is, what effect will that have on your Social Security benefits later? And now I understand the question. And here's the honest goodness answer. You pay in less, you will get less of a benefit. No ifs, ands, or buts. You pay in less, you will get less of a benefit. But here's the deal. All right. The rest of the story, Connie, is you take that savings every year and you find a way to invest it. And I tell you what, I've been doing for my entire career. I've been buying rental properties with that money. All right. So what you do, Connie, is you're replacing that lower benefit by investment returns on the savings. Right. So the answer to your question, you are right. You pay in less, you get less benefits. Okay. So I misread your question earlier. I thought a different direction. All right. But you pay in less. By savings with the S corporation, your benefit will be less. So you're going to invest the savings every year in another type of investment to make up for the difference. Okay, tell you what I want to do. I think I've got everything unless All right, what I'm going to do is I'm going to jump back to this, everybody, and then we're going to sign off, and we're real close to 3 anyway. But I'm going to go back to a specific slide to answer Prasad's question right here. All right. So everybody, here's the deal. Okay. What Prasad is doing is he's looking at this slide and he's referring to the bottom right-hand corner, which is in error. And I apologize, Prasad, I did not update this. All right. That footnote with the asterisk, everybody, where it says 36.5 is a forced number, should be 43,500 is a forced number, mea culpa, and refers to the asterisk about 4 numbers up in that right-hand column. The forced number, everyone, is the difference between, in that right-hand column, 22.5 and 66 grand. All right. So the forced number is the difference. So this is the way it works. All right. But Prasad, you were right. The 36.5 needs to be changed. All right. And just watch this. I'm going to try something here real quick. Never make that mistake again. Got it, Prasad. All right, everybody, I want to thank you. I have thoroughly enjoyed this. The only thing I did not cover were those tax credits on your principal residence, second home, and the vehicle credits. The Secure Act 2.0, which was never going to be covered much in detail. Take a look at those slides on your own. You are welcome, Paul. They got my slides. You are welcome to use my slides, everybody. Do a presentation to your clients if you can. I mean, you don't have to give me credit. I don't care. But show them to your accountant and see what they think. Show them to your financial advisor, for example, on this particular screen. They are all correct. And I truly enjoy my relationship with CRS and RRC and all of you that I've met over the years. Come up and say hi at a convention or celebration, whatever, or I'll see you in your state when they hire me to come up and do a seminar or something. Paul, thank you for your time today. I thought this went extremely well, and I'm going to sign off.
All right, Chris, you want to stop sharing your slides?
I will do it.
I have a final slide just throw up there. Make sure it's still all lined up. There we go. I just want to let everybody know. Well, first, Chris, in case you do have to run, I just want to say thank you so much. What a great wealth of information here. And we're looking forward to when you come back on February 7th, that Chris had mentioned at the beginning, to do an update on this and anything else he's talked about. And now this has just been, well, today it happened to be 2 hours, but he does have a course called Tax Strategies for the Real Estate Professional. It's an all-day course. If you want to see that in your area, contact your local associations. Let them know you want Chris to come and speak about this topic and go a lot more detail. And he's actually has one coming up on January 30th for next year. It's in Downers Grove, Illinois. It's going to be hybrid, and tax strategies for the real estate professional. That's coming up January 30th. But like I said, you know, and if you're watching the recording of this and you're like, well, it's already past January 30th, all you got to do is go to crs.com, hover over where it says education, go to the catalog, click on live courses, or class. I think it'll be called classroom courses. Sorry, classroom courses. And then you'll see any upcoming courses, and you can search for Chris there. And like I said, we'll be back here for sure on February 7th for the next webinar. And our next webinar is going to be October 23rd. Another one of our instructors, Craig Grant, Cybersecurity, Top Risks and Scams, Targeting Real Estate. That is the member benefit webinar. It is free to all RRC members. And if you did buy that bundle, that is in your account already, and you will have access to that. But if you didn't sign up for the bundle and you haven't signed up for that webinar, you can go and sign up for that now. And the rest of our webinars for this month are listed there. And Chris, before we get out of here, is there anything else you wanted to add or say?
No, we're good. Everybody have great holidays, and I will see you next year.
All right, Chris. Thank you. Thanks, everybody.
My pleasure.